Welcome back, everybody. Mr. Clark here. Today we're talking about dividend income. So when we buy a stock, we think buy low and sell it high, right? We're turning a purchase into a profit. And that's the general thought of the stock market, and that's great. You can do that. Another avenue is to buy a dividend stock, a stock that pays a quarterly or annual dividend. Typically, it's quarterly, and then there's a number on it they call it an annualized dividend over the course of a year, and it pays a percentage of the profits of the company's success that in that year, that quarter, whatever. And not all companies do this. Some can say, "I'm not doing it this quarter. We're just not going to pay it." And there are some that have not paid dividends for years. Um, but a number of them do. In fact, there are some companies that function with the only way that they're owners of the company getting paid is through dividends. So you're guaranteed they're going to pay. That dividend comes as a percentage of the total profits in there. So if you own one share and you're earning $1 per quarter, then you'd earn $4 in the course of a year. Now maybe it's not $1, it might be 50 cents, or it could be pennies even, or it could be thousands of dollars depending on what's set up. But if you have multiple shares, you're going to get dividends on every one of the shares, and that starts to add up. So let's get started. So again, dividends. We are talking about dividends. This is the I always think of dividends like when I'm playing Monopoly, which we don't play around here. It's a dangerous game. Everybody gets mad at each other. You can get dividends. We also call them income stocks, and we say the yield of a stock is the percentage value of the dividend compared to the current price of a share. That's important because when we talk about dividends, we want to know how well that stock is doing compared to other ones. And so we can say, let's say it pays at $1.20 and its a yield is, or the stock value is $20. We can calculate our stock yield at looks like we're at 0.06, so 6%, right? And we can compare that against other stocks. But honestly, for this is my big takeaway. If I'm making $1.20 over the course of a year, if I have 1,000 dividends or 1,000 shares of the stock, that's huge. And so now, right, I'm making, there we go, one too many there. Sorry about that. If I'm making 1,000 or $1,200 a year for doing nothing, that's pretty cool. Now there is tax applied to this, but again, this can be happening constantly. You can be making this money and really doing nothing for it. And then as you get more of this money, you can then go and purchase more shares of stock. I can spell, I promise. You can purchase more, and you start to create this curve where you get exponential growth, right? We like seeing that, at least in money terms, in our bank accounts. There's two types of stock. There's preferred, two main, and common. And preferred sounds better, common sounds common. Well, that's okay. Preferred stock just means simply that they are going to get paid dividends before common do. They're going to usually have a set dividend, which isn't frequently changed. And if the company goes out of business, preferred stockholders are entitled to assets and earnings that the common stockholders may not get if there's not enough. They're going to get it first, being preferred. Again, when you're buying stock, you're buying part ownership in this company. So that's important because we're going to talk about bonds later where you don't actually have ownership. The payments can come electronically. You can get a check. They can be a few cents to a few $1,000s. But let's just do an example here. We're going to go and say 700 shares. And we're going to say at $2.13. Now we could say this is annualized. Probably more accurately annualized because $2.13 a quarter for share is pretty crazy. But hey, if you get lucky and find something like that, snatch it up, right? So we're getting $14.91 each year for doing nothing. And that's great. What if we're getting paid quarterly? So you might see something like, let's see if I can find it. Yeah, here we go. So Blackstone's just an example. You can see their value over time, right? This is pulled from Fidelity. You can just type in BX or any other stock ticker in there, you're good to go. Ticker here, price, what it's up at, all this information. But what we want to look at is down here in this range. Oh, nice. 61 cents, the most recent. Again, that's a quarter for one share. If you had 10 shares, you'd be looking at $6. Well, $6.10. If you had 100 shares, $61, right? For doing nothing. Now you wouldn't necessarily buy 100 shares, $4,900, almost $5,000 to get that, but maybe you would long term or over time because this price is going to fluctuate. Let's say they do a stock split, and now you can get it for 24, $25. That's going to change things. But notice this right here, this 4.07, this is the dividend yield. Roughly speaking, that's their yield. This is it over time. These are the number of quarters going through, right? Every quarter they pay this out, and you get that no matter what. It could be pennies, it could be more. Regardless, you're getting paid this much per share. In our example, we used $2.13 per share at $14.91 a year. But we notice again, we saw quarters. Let's say you're getting paid quarterly at 51 cents a share. And we could say 2,000 shares just for easy numbers, right? 2,000 shares times 51.51, excuse me. $1,020. But that's quarterly. So 4 quarters in a year, we're looking at $4,080 for doing nothing. It's a pretty sweet deal. When we want to compare stocks, we need to use what's called the yield. So the yield of a stock, this is kind of our comparison. We want to say, wait, what's the stock compared to other stocks? What we take is the annual dividend. I can spell sometimes. Per share. And then over the current price of the share, whatever the current trade value is. Again, going back to our image here, we have our quarterlies, we have our annual. We could say this is the dividend right here, most recent. You can actually go and find, and I forget how you find it in here, you can actually find what's listed as the annual dollar amount for their stock. I always forget where they are. They've changed things since I last looked at it. But anyways, and so when we look at that, we can then calculate whatever that percentage is as a percent and use that for a comparison. So let's say $1.40 at and $57.40 a share. That's about 2.439%, or roughly 2.4%. There we go. 2.4%. Another example, if we want to look at the information, is look at what change from today versus yesterday. We can look at yield from a previous day by taking, we say yesterday's close. So if it was yesterday, and that's going to be the value that we're going to use, we would actually say, let's say yesterday's close. Well, we know today we closed at $34.50 a share, and that was at a negative 50 cents. So yesterday's close would be $35 a share, and we take whatever our yield is. Let's say the dividend yield, whatever the annual dividend is, $1.20. We can actually get about 3.4%. That is at yesterday's close. Our yield was about 3.4. There we go. Percent. Not one of the things we have to understand is when we're doing stocks, we are constantly comparing them to previous data. You can do a 7-day yield and figure out what we've changed over the course of a week to decide what's going on. Again, as visible by here, that's this data, and that's where they calculate a year to year. This is how they calculate here. We've got a change of 9% or 9 cents, 5 cents, 5 cents, right? We're still looking at here. We still have to wait to get that information. But we can look at all this information, and that's where it's coming from, is comparing our data against before. And that's one of the biggest things we do. One thing that we can recall from our last lesson, we talked about stock splits. If we have a stock price of, let's say, $2.14, well, let's say a yield, a dividend, sorry, of 214, and they do a stock split 2-to-1, we know that we are now going to have 2 shares for every 1, and that's going to be at $1.07 a share. That's just doing a 2-to-1 split. We could check that for a 3-to-1 or a 4-to-1 split, right? Understanding that the value per share is going to come down and the number of shares is going to go up, and then if we have fractional shares, they'll pay us at that new value, whatever that is. Now, one last thing, if you don't want to deal with this, you want to deal with some other business benefit. So rather than owning part of the business by being a shareholder, by owning stock, you can buy corporate bonds. So corporations offer bonds. Another way to build money, that's why they sell stock, is to get it capital to produce or do other things. They sell bonds for the same purpose, but typically bonds are paid at maturity. So you can go a 1-year bond, you go a 30-year bond if you wanted to. Whatever that is, they're going to pay you a rate based on your face value, which is what you buy. So let's say it's $1,000. You could go 5,000 or whatever. But let's just use the 1,000. So at $1,000, and let's say they've told you, I don't know, they're going to pay you a rate of 5.7%. Again, that's 0.057, right? $1,000. The way I would calculate it, if you want to know that's the total value paid back, is times 1.057. This is going to give you your face value plus the interest, and that gives you $1,057. Now, if you wanted just to know the interest earned, obviously you could take that minus and get your 57, or you could have just multiplied by the percent and left the 1 off. It doesn't really matter. But that is in a nutshell what we're talking about when we talk about dividend income. It's pretty straightforward. You get money for doing nothing, right? That's great. We all like doing that. Again, the dividends aren't always guaranteed. We have to understand that. They could say, you know what, we're not paying them because we need the money for growth, or they could be hurting for years at a time and not have enough money to pay. And so there's lots of things that can go wrong. But again, as I've mentioned before, in the stock market, if you're going to pay to get into the stock market and invest in anything like that, do it with money that you don't need. Don't spend your rainy day fund on things that you could lose. That's a bad investment. That's not sound advice. My advice is invest in things that are going to work long term. Understand that investment is a long term game. It's the long con, but not a con, right? It's the long term strategy of buy and wait and sell when it's higher. And with dividends, buy and let those dividends come in. Use the profits to buy more and create that growth so that when you retire, you have the extra income to cover whatever else you have, a 401k, a pension, inheritance, Social Security if that's available, or how it looks, I don't know. But all those things will add up as financial cushions for you in the future. But that's what this is. That's what dividend income is. The long-term strategy is don't worry about it only makes 50 cents a share. That's fine. If you have 1,000 shares, 10,000 shares, that money is going to add up. If you have questions, shoot me an email. Let me know. This is the last section for this chapter, so I will get a review video set up here in the next couple of days. I look forward to answering any questions that you have. And as we continue with distance learning, best of luck. Please keep communication open. I am always available via email. Check in Schoology, do something so that you can get a hold of me so that you can make sure you understand this. We'll see you next time.